Want to boost your trading success with high probability chart patterns? In this video, I'll reveal 3 powerful patterns with a 90% accuracy rate that can help you make consistent profits, even if you're just starting out. Stay tuned, because missing these could mean missing your next big trade. Both the falling wedge and rising wedge patterns are technical chart patterns that indicate a potential breakout. They are formed by converging trend lines and suggest either a reversal or continuation of a trend, depending on the market context. Falling wedge. The falling wedge is formed when the price makes lower highs and lower lows, creating a downward sloping wedge shape. The upper trend line slopes downward. The lower trend line also slopes downward, but at a lesser angle, meaning the price movement is compressing. A bullish breakout is expected, meaning price is likely to break above the upper resistance trend line. The falling wedge can appear in 2 different market conditions. 1. As a reversal pattern. The pattern signals that sellers are losing momentum and buyers are preparing for a breakout. The breakout confirms a trend reversal, shifting from a downtrend to an uptrend. 2. As a continuation pattern. The price temporarily consolidates within the wedge before continuing upward. This pattern often acts as a bullish pause before resuming the original uptrend. Confirmation and entry strategy. A breakout above the upper trend line confirms the pattern. Ideally, an increase in volume should accompany the breakout for stronger confirmation. A common entry point is when the price retests the broken resistance line as new support before moving higher. Stop loss. Below the recent low inside the wedge. Profit target. The height of the wedge at its widest part added to the breakout level. Rising wedge. The rising wedge is formed when the price makes higher highs and higher lows, creating an upward sloping wedge shape. The upper trend line slopes upward. The lower trend line also slopes upward, but at a steeper angle, indicating that the price movement is narrowing. A bearish breakout is expected, meaning price is likely to break below the lower support trend line. The rising wedge can also appear in 2 different market conditions. 1. As a reversal pattern. This signals that buyers are losing momentum and sellers are preparing for a breakdown. The breakout confirms a trend reversal, shifting from an uptrend to a downtrend. 2. As a continuation pattern. The price temporarily consolidates within the wedge before breaking lower. This pattern often acts as a bearish pause before resuming the original downtrend. Confirmation and entry strategy. A breakout below the lower trend line confirms the pattern. Ideally, an increase in volume should accompany the breakdown for stronger confirmation. A common entry point is when the price retests the broken support line as new resistance before moving lower. Stop loss above the recent high inside the wedge. Profit target. The height of the wedge at its widest part subtracted from the breakout level. Double bottom formation and structure. The double bottom forms after a downtrend when the price reaches a support level twice, but fails to break lower. It creates 2 distinct troughs at nearly the same level, separated by a moderate pullback. This indicates that selling pressure is weakening, and buyers are likely to take control. A bullish breakout is confirmed when the price breaks above the neckline. The pattern forms after a strong downtrend and signals a possible reversal into an uptrend. It suggests that sellers attempted to push prices lower, but failed twice, leading to a breakout. Confirmation and entry strategy 1. Break of the neckline. The pattern is confirmed when the price breaks above the neckline with strong volume. Second retest of neckline, optional. The price may briefly retest the neckline before continuing upward. Third entry. Traders typically enter long when the price closes above the neckline. Stop loss. Below the second bottom to avoid false breakouts. Profit target. Measure the height between the bottoms and the neckline, then project it upward from the breakout point. Double top. The double top forms after an uptrend when the price reaches a resistance level twice, but fails to break through. It creates 2 distinct peaks at nearly the same level, separated by a moderate pullback. This indicates that buying pressure is weakening and sellers are likely to take control. Breakout direction. A bearish breakout is confirmed when the price falls below the neckline. The pattern forms after a strong uptrend and signals a possible reversal into a downtrend. It suggests that buyers attempted to push prices higher, but failed twice, leading to a breakdown. Confirmation and entry strategy 1. Break of the neckline. The pattern is confirmed when the price breaks below the neckline with strong volume. Second retest of neckline. The price may briefly retest the neckline before continuing downward. 3. Traders typically enter short when the price closes below the neckline. Stop loss. Above the second peak to avoid false breakouts. Profit target. Measure the height between the peaks and the neckline, then project it downward from the breakout point. Ascending triangle. The ascending triangle is formed by a horizontal resistance line at the top and a rising trend line at the bottom. The price makes higher lows while consistently testing the same resistance level. This pattern shows that buyers are gaining strength, pushing the price upward. The price typically breaks above the resistance level, confirming a bullish breakout. It often appears during an uptrend, acting as a continuation pattern before further gains. It suggests that demand is increasing, and once resistance is broken, buyers take full control. 1. Breakout above resistance. A strong bullish candle closing above the resistance confirms the pattern. Second retest of breakout level, optional. The price may retest the broken resistance as new support before continuing up. Third entry, traders enter long when the price closes above the resistance with high volume. Stop loss and target. Stop loss. Below the most recent higher low inside the triangle. Profit target. Measure the height of the triangle at its widest point and add it to the breakout level. Descending triangle. The descending triangle is formed by a horizontal support line at the bottom and a falling trend line at the top. The price makes lower highs while consistently testing the same support level. This pattern shows that sellers are gaining strength, pushing the price downward. The price typically breaks below the support level, confirming a bearish breakout. It often appears during a downtrend, acting as a continuation pattern before further declines. It suggests that selling pressure is increasing, and once support is broken, bears take full control. Confirmation and entry strategy 1. Breakout below support. A strong bearish candle closing below the support confirms the pattern. Second retest of breakout level, optional. The price may retest the broken support as new resistance before continuing down. Third entry. Traders enter short when the price closes below the support with high volume. Stop loss and target. Stop loss. Above the most recent lower high inside the triangle. Profit target. Measure the height of the triangle at its widest point and subtract it from the breakout level. If you want to master identifying the perfect order block using ICT and SMC concepts, this video is for you. Learn the key strategies that pro traders use to stay ahead of the market. And here's the deal. Once we hit 100K subscribers, I'll show you my real account balance so you can see that you're learning from a true pro. Don't miss out. Subscribe now.